and welcome to Lynnhaven River Now's flood insurance webinar. We're looking forward to this and think it's going to be a very informative evening for you. As people sign on, I'll turn it over to Karen in just a second, but my name is Jim Deppie. I'm the advocacy coordinator for Lynnhaven River Now. And before we start our webinars, we'd like to acknowledge whose land we're on. And so we acknowledge that we occupied the traditional lands of the Chesapeake and Nansemond people. They were careful stewards of these lands and waterways for thousands upon thousands of years before the Europeans arrived, and they continue to live among us and guide us in the traditions of caring for the land and the water. We're hopeful that gatherings such as this will help us to honor them and to follow their example of stewardship. Now I'd like to turn it over to Lynnhaven River Now's Executive Director, Karen Forget, who will introduce our panelists.
Thank you, Jim. As Jim said, I'm Karen Forget, and I'm the director of LRNow. And I'm very happy to welcome you here, whether you are joining us live this evening or you're streaming this from our YouTube channel at a later date. We feel like this is really, really important information for everyone in Virginia Beach. It has been recommended by the city and by others that everyone in Virginia Beach should have flood insurance. But that recommendation sort of falls on deaf ears if we don't know as citizens how to go about doing that. Some of us are required to have FEMA insurance, and Mary-Carson Stiff is going to fill us in this evening on all the really important ways that the FEMA program is changing and information that you should have if you carry FEMA insurance. Whitney McNamara with the City of Virginia Beach is going to help us understand how the things that the city is doing through the community rating system is helping to lower all of our insurance rates. And Mike Vernon is a private insurance broker who has an expertise in flood insurance and flood mitigation, and he's going to help you understand what your options are if you're not required to carry FEMA insurance, but you still want to carry flood insurance, how, where you can get that, and what you can do to lower your private flood insurance rates. So let me give you a little background on our three speakers, and then we're going to turn it over to them. A couple of housekeeping things. One is that we are recording this and we will make it available on YouTube. If you registered for the program, you'll receive a YouTube link in the next day or two. And we encourage you to share that link with your neighbors and friends and others, because we feel like this is really valuable and important information that everyone should have. And then secondly, in the housekeeping arena, we're going to wait and do all questions at the end of the program. So if you have questions as they come up while our speakers are presenting, you can jot them down yourself, or you can type them into the chat. So if you're not as familiar with Zoom, you might want to make sure right now that you know where the chat function is on your screen. If you want to test it out, you can put in what neighborhood you live in, because that would be helpful for us in kind of seeing the distribution of people throughout the city who are interested in this topic. And we will use the chat for all questions. All right, so our first speaker, as I said, is Mary-Carson Stiff. Mary-Carson is the Director of Policy at Wetlands Watch, where she specializes in the National Flood Insurance Program and sea level rise adaptation planning and policy. She's a certified floodplain manager. She's chair of the Coastal Virginia Community Rating System Work Group and a board member of the Virginia Land Conservation Foundation. She is also serves on the Virginia Flood Management Association and the Living River Trust boards. Before joining Wetlands Watch, she worked as consulting manager for policy and programs for the Virginia Coastal Policy Center at William and Mary Law School, where she obtained a JD. She's very well qualified to talk to you about the FEMA insurance program and FEMA 2.0. Our second speaker, Whitney McNamara, is an environmental planner for the city of Virginia Beach. She has worked for the Department of Planning and Community Development since 2012. She divides her time between staff support for the Virginia Beach Wetlands Board and managing the city's floodplain and community rating system programs. Whitney graduated from Duke University with a master's in environmental management with a concentration in coastal environmental management. And our third speaker is Mike Vernon. He's the founder and CEO of Flood Insurance Hampton Roads. His company is a full-service insurance agency with an emphasis on flood insurance and flood mitigation services. Mike has designed more than 1,500 completed mitigation projects. The purpose of flood mitigation is to reduce the cost of future storm events, reduce structural damage to buildings, reduce population displacement, and allow for faster economic recovery. Mike has presented to over 7,000 real estate professionals concerning flooding, flood insurance, and their impact on the value of real estate. He has also presented to dozens of civic leagues, nonprofit organizations, universities, and professional associations. He has contributed his results of his studies to the Virginia Institute of Marine Science and the ODU Entrepreneurial Center. So we are very, very lucky, and you as our participants are very lucky to have all three of these amazing speakers with us tonight. So we're going to start with Mary-Carson Stiff, who's going to talk to us about the FEMA Flood Insurance Program.
Thank you, Karen. Hi, everybody. It's great to be with you this evening. Can you see my screen? Yes. Okay, super. All right, so I'm going to be talking about the National Flood Insurance Program and specifically the way in which the program is changing and has changed significantly for the first time since Nixon was president. So this is a kind of a big modification, and it will impact you if you have a flood insurance policy with the National Flood Insurance Program. I'm going to kind of just for a second talk about our organization. I work for Wetlands Watch. We're a nonprofit based in Norfolk, Virginia. We work on sea level rise issues, climate change, and we're really focused on how nature can be incorporated in communities' response to increased flooding and sea level rise. And we're interested and invested in this work because our tidal wetlands are greatly at risk from inundation from sea level rise. They're drowning because of that higher water level, and we're looking at somewhere in the ballpark of 50 to 89% loss of our tidal wetlands due to this changing conditions. So things are pretty dire. We work in the FEMA and flood insurance world because this is really an important program that impacts how local governments manage the development along the shoreline and how individuals respond to increased flood risk. So that's where we're kind of coming from in our flood insurance work. So I have the privilege to talk about this big change, and I look forward to sharing the news about it. All right, so here's the kind of gist. Risk Rating 2.0 is what FEMA is calling this massive overhaul of the program. This is a change to the insurance side of the National Flood Insurance Program. And the change is really related to how FEMA decides how much your policy is going to cost. And more specifically, the rate of risk is what is changing. So flood insurance rate determination is being modified with this risk rating 2.0. The rates are no longer set by where a structure falls on the flood insurance maps that FEMA distributes to every community that is in the National Flood Insurance Program. And for your reference, all of our Hampton Roads communities are in the National Flood Insurance Program, and there are very few communities in Virginia that are not participating in the National Flood Insurance Program. So FEMA is the one who is setting those maps and sending them to local governments. And those maps used to determine how much your rate cost. And now that is no longer the case. So zones on the map are not going to affect your flood insurance rate. Subsidizing of rates is essentially going away. So there was a lot of subsidizing of older homes, which would help address some, cost issues associated with having a house that was built before the National Flood Insurance Program became an effective program. It is an insurance program, but it also is a regulatory program. And so when a local government decides to participate in the program, they have to agree to do certain things that keep people and property safe from flood risk. And it's those minimum standards that local governments are responsible for enforcing. And that kind of program became effective in local governments in the 70s. And so a lot of houses, especially in our area, were built before 1970. And so this grandfathering was a way to keep costs down for those older houses that were not built to those minimum flood risk standards. So that subsidizing is going away. And there used to be a really significantly reduced cost flood insurance policy that was available for properties that were outside of those highest flood risk zones. And that basically means that if you bought a house that wasn't in a high risk zone and you had a federally backed mortgage, you were required, and you still are required, to buy flood insurance through the National Flood Insurance Program. But if you had a house or purchased a house that was outside of those high risk zones and you weren't required to buy flood insurance if you had a federally backed mortgage, then you would have one of these cheap voluntary policies. And these are called preferred risk policies. And they were generally about $500 a year. FEMA is getting rid of those policies because the rates are no longer based on the flood maps. And those voluntary policies, or the preferred risk policies, were really only available outside of those high risk flood zones. So those are going away. The value of somebody's structure is going to go into the consideration for your rate for the very first time. So we're going to talk a little bit more about that later on, but essentially, your structure's replacement value is now a factor in your flood insurance rate. And there was a lot of kind of disparity and inequity in how FEMA was rating properties that had very, very different values. They were rating them the exact same way, and they're doing away with that practice. The kind of biggest, most important takeaway is that FEMA is now trying to get your flood insurance premium to be reflective of the full risk rate of your property. So that's kind of the nomenclature that the National Flood Insurance Program and FEMA is using. This full risk rate is something that you're going to hear a lot in this presentation, and it's intended to be more reflective of real risk and be based on real science that is driving and defining that risk. So these full risk rates are still subject to those congressional caps that were put in place in 2013, 2014, with some pretty big congressional legislation for flood insurance reform. And we're going to talk more about that. But essentially, it just means that Congress passed a law that says, okay, National Flood Insurance Program, you really can't increase annual costs of flood insurance too much each year. So trying to keep the burden low on policyholders. And those caps are an 18% annual cap for primary residences and a 25% cap for secondary residences, investment properties, or businesses. So when did this happen? FEMA tried to phase it in. So any new policy, so anytime you were purchasing a home and you needed to carry flood insurance, or you wanted to carry flood insurance, and everybody in Virginia Beach, everybody in Hampton Roads should have flood insurance, because it can flood absolutely anywhere that it can rain. And Lord knows we have enough of a tidal influence in our region that it can flood from tidally influenced events, as well as our major storm events. So new policies, this risk rating 2.0 methodology became effective October 1st of 2021. And then for existing policies, so this is, you have a house, you've lived in it for 10 years, and you have had a flood insurance policy for every year, and you're just going to cycle and renew. And that typically occurs when you purchased your home, because your policy is looped into your escrow. Then for those policies, the change happened on April 1st of this year, so just a couple months ago. So this is a phased approach, and they tried to do that to, I'm sure, stagger some of the impacts of this enormous sweeping change. So why did they need to make this change? I mentioned that this method had not been modified since Nixon was president, and they started the National Flood Insurance Program in the 70s, and they did not change the way in which they were rating policies since then, since the inception of the program. So that's outdated, obviously. They wanted to use new science and technology that is now available. Of course, science and technology has improved since the 1970s. That's a no-brainer. But of course, even more recently, technology is continually changing, and typical insurance programs are always modifying their rating method based on new science and new technology. So they're trying to be a little bit more like a real insurance company, less of a government program. This new science and technology leads to more accurate risk. They also are finally kind of adopting a policy or an approach that is supposed to be reflective of the fact that many of us know, especially after Hurricane Matthew, that flood zones are just lines on a map. Floodwater doesn't give a rip about where those lines are. And so that this change is supposed to be reflective of that reality. There were a lot of issues with the equity of the flood insurance program. When the insurance rates were not factoring in the replacement costs of structures, you had a large, equity problem with people paying the same rates, but living in entirely different sizes of homes, values of homes, and different life circumstances. And so this is supposed to address those equity issues. The flood insurance program is changing, and this full risk rate approach is intended to address this enormous debt that the National Flood Insurance Program finds itself in, $20.5 billion of debt. And this debt is serviced by the National Flood Insurance Program, and the interest on the debt is paid by premiums. And so they are trying to figure out a way to cover the costs so the National Flood Insurance Program can be more solvent. And that solvency is essential because of all of the increases in our storms that we're seeing. You can probably guess that those preferred risk policies, or those policies that were only like $500, but they could be located directly next to a property that is in the flood zone, but they were out of the flood zone. That, is a really untapped market, I guess is the best way to say it. And the National Flood Insurance Program has finally realized that, or at least they've acted on realizing that. And so they've decided that preferred risk policies are far too inexpensive when they are in areas of, approximate risk. And so they're going to increase the premiums of those non-high flood zone risk premiums or policies, excuse me. The debt is alarming. And as I mentioned, it is absolutely correlated to our higher occurrence of storms and our increasing severity of the impacts of our storms. So there is a great need to address this high debt because, of course, the borrowing authority is directly related to how much debt the program is carrying. And Congress has canceled a significant amount of it to enable a borrowing authority of any kind. But there's much more that needs to be done to bring the program into out of the red into the green. So let's kind of dive a little bit deeper into how things used to be versus how things are today. As I mentioned, the old rating methodology was based on flood maps. It was also based on the elevation that a big storm kind of brings along with it. So that's called the base flood elevation of your structure, the type of foundation, and then, of course, based off of that 100-year or the 1% annual chance of flooding. That 100-year storm is a marketing problem that the National Flood Insurance Program has. We definitely are seeing 100-year storms happening more frequently than 100 years. And it creates this false sense of safety for people that are living in these areas. And certainly the lines are associated with that 100-year designation. And we know that those lines mean very little in terms of risk. So now this data or this rating methodology has completely changed, and it is now based on a lot of different factors, many different factors. And there's a lot of unknowns that we have about how these factors are weighted and relate to one another. And so the rating is exceedingly complicated and somewhat unknown to our raters. And I think Mike's probably going to talk a little bit more about that, but just so you know, there isn't some sort of matrix that we all have access to see how everything interplays. Some of those factors include cost to rebuild, which is a really big one. All of the data that FEMA used to understand risk is immense, right? It's a lot of storm, historical storm data, predictive storm data. It includes a lot of high resolution elevation data that's taken from the sky. It's called LIDAR. It includes a lot of different resources that have been designed by FEMA contractors. And it also includes things that are relative to the structure that's receiving the rate. So distance to a flood source. There's a special factor for distance to the coast, which matters a lot for our region. The ground elevation, the height of the first living floor. So your first floor, not necessarily your basement. What your house is made of, what kind of construction your house is composed of. And then a lot of alternative flood frequencies. So not that 100-year storm event. They're no longer putting all of their eggs in that basket. They've expanded it to include smaller storm events, larger storm events that are happening more frequently, that are large and small. So big variability there. This map, if you have looked at flood insurance rate maps, should be familiar to you. This is a screenshot of the map in the Hague neighborhood of Norfolk. This just shows how things used to be in terms of how your rate was established. The blue color represents those high flood risk zones where flood insurance is required if you have a federally backed mortgage. The orange represents a lower flood risk zone where there is no flood insurance mandatory carrying requirement. And then the no color is those areas of lowest flood risk. And so for the purpose of regulatory programs and local government land use, this map is still relevant because there are certain things that are required in the higher risk zones that are not required in the lower risk zones as far as building goes. So you have to build higher if you're in a higher flood risk area. You don't have to do that if you're in a lower flood risk area, et cetera. But from a rating standpoint, this map is no longer relevant. So that's important to know. I'm going to do a little bit of a deeper dive into some of the rating factors. The distance to flood source. So before, in the past rating program, the distance to a flooding source was not taken into account. But now the distance to the flood source is taken into account, as is the specific flood source itself. So that's a big difference. For the coast, the distance to the coast is a big factor. In the old method, there were some coastal factors, but less. It informed the rate in a different way. Under the new system, you're essentially considered at coastal risk if you're 50 miles from a coastal water body. And that's because, as you can see here, this is an example from South Carolina. The impacts of coastal flooding when you have a lot of intercoastal waterways becomes a big deal. And so just being directly next to a water body is how we used to do it. Now we're really looking at those larger impacts during our storm events when you're close to the coast, but maybe not right on it. This is a hypothetical example. I almost hesitate to even use this slide, but essentially it just shows the difference in two properties as they are, relationally to the water. So this house is closer to the flooding source, and it will have a higher premium than the second building that is farther from the coast. That's really all it illustrates. The other big factor is the replacement cost value. So when you have a $2 million home and a $250,000 home, and they're right next to each other and they experience the exact same flood risk, these people should not be paying the same in flood insurance. And under the old system, they frequently were. And FEMA received a lot of pushback about this issue, and for pretty obvious reasons. And so now this replacement cost will be considered into the rating, and this property owner will pay less than this property owner is the hope, and that's what they intend that factor to do. So let's talk about how it's actually working in practice. The rate is determined by the FEMA rating model data that they have. That's kind of proprietary information that FEMA uses, that they created with their consultant contractor. Then they have what the insurance agent is putting into a data source that's on a web-based platform. And that spits out the actual rate. So what are we hearing in practice? We're hearing that square footage seems to have the biggest impact on cost, and that's related to that replacement cost value and size of the structure. Enclosure types like basements have a very small impact on cost. And this is odd because if you live in this region and you have a basement, you know that might not make sense. So that is something that we're seeing that might be an unintended consequence of this enormous big change that the National Flood Insurance Program is going through. We're also seeing that mitigation measures are having a very small impact on cost. FEMA has released some new information that seems to imply that elevations are supposed to have an impact on cost. And I think that FEMA is working on modifying how the rating is working now, so those elevations are going to continue to be financially desirable in terms of what your rate actually is. But right now, that seems to be a little bit iffy. Elevation certificates can help, but they have a minor impact on a cost difference in your rate. So that might be something that Mike's going to talk about a little bit, but elevation certificates aren't required anymore to get a flood insurance rate under risk rating 2.0. The rating methodology data, I've already said this, it's proprietary, and FEMA is not disclosing how the rating really works and the interplay between all the factors. So when are policies going to reach these full risk rates? Well, we know that the majority of policies are going to reach them in 10 years, basically. So 25 years is 25% will reach them by year 1, 50% will reach them by year 5, and 90% will reach them by year 10. I mentioned that the rates are changing, and that's because many rates are increasing, but these full risk rates is kind of when you stop increasing annually with those congressional caps. So the caps for this first year of the rating methodology, the good news is that no policy holder of a primary residence is going to pay more than $12,125. So that's good news, because it used to be the case that a premium could pay as much as almost $46,000 annually. So costs are going down, but there is ambiguity because that full risk rate is a moving target, and that is providing a little bit of confusion for policyholders. So what is the impact of this? 23% nationally, 23% of policies are decreasing immediately. So that's getting to that equity issue of people paying way too much based off of their available, ability to pay, and based off of the value of their home. And then we're seeing increases that are small. So about $120 a year per a year increases. About 66% are in that small increase category. And then we have some larger increases happening at 7% and 4%. For Virginia, we have a high percentage of premiums that are going down immediately. So once they go down immediately, that means that they're done. They're at their full risk rate, and there's no increasing, no nothing. That's just what they're going to pay, that full risk rate, until the rating methodology changes. We're seeing, over 50% increases, and that makes sense. It's consistent with the messaging of the risk rating 2.0. People have been paying too little. We're increasing costs to make the program more solvent, et cetera, et cetera. So the good news is that 48% are increasing at that $120 per year rate. By class, the majority of our policies in Virginia are increasing if you are a preferred risk policy. So this is really getting at that untapped resource of revenue for the program. So preferred risk policies, if you have an elective policy, it's going to increase. This is full risk zones. So there will be a lot of policies immediately reaching their full risk rate. And then we have pre-firm subsidized, and this is actually the high coastal risk zones, which is a little counterintuitive, because you would guess that we would have a lot of coastal high risk properties increasing, but we really don't. How is this happening? What is the experience like? This is not a real letter, but based off of a real one. You're going to get a letter from the National Flood Insurance Program at the time of your renewal, and that letter will say very little about what risk rating 2.0 is, which isn't super helpful. So it's important that everybody kind of talk to your neighbors, talk to your friends, etc. And then you're going to want to double check FEMA's data for your property. Basically, there's going to be some weird stuff on this, like 99 elevators on your property. That's really not likely. And so there's some missing data that FEMA has, and they're using this. They're saying with transparency that that is the case, but you're going to want to read this and then correct FEMA, because the more correct you are, the more correct your rate will be. We're very interested in the impact of this rating change, specifically because the National Flood Insurance Program has different functions. It provides a floodplain management function, which is the regulatory side of things. It provides flood insurance, and it also helps with that hazard identification through its mapping program. And it's kind of hard because the mapping was very related to the flood insurance at one point, which provided the nice kind of buttressing or cross sections of this functioning stool. And we're sort of doing some stuff to kind of mess with how it's all flowed together. And so there's just a lot of unknowns with how this is going to roll out. A couple more of our concerns and what we're hearing: this mitigation premium reduction is of concern because you want people to mitigate their properties so they're safer from flood risk. The premiums are really difficult to estimate, and they're all over the place. And so there will be an impact on how real estate agents can advise prospective buyers in our region. And I think this is something that we should be aware of. And they're changing the program and updating it every Thursday. So that's kind of a fun thing. We don't quite know when the updates are how the updates will affect us. We're not really sure. And then this is a little bit of a bigger issue, but when FEMA makes a mistake on your rate, and that mistake means that you were paying far less, but now you're about to pay far more, that far more doesn't have to be in that 18% or 25% congressional cap increase. So that's a big issue, and people could be in pretty bad financial positions if they aren't able to pay for the new non-mistake rate. Insurance agents, this is the Wild West. We're still learning stuff every day, and this is all like an entire program that I run in our organization. And so if I'm confused, agents are confused, and not all agents are like Mike, and following this very carefully. So we're also very concerned about our voluntary policies being dropped. And this is a big deal because, as Karen kind of opened this webinar, Virginia Beach has kind of said we want all of our property owners to carry flood insurance. Hampton Roads as a region through our planning district commission has said everybody should carry flood insurance because it helps protect you and allows you to have economic stability during and after a flood event. And so the dropping of policies where people didn't have to have them is definitely going to happen because people aren't going to want that added expense. And that makes us nervous about everybody's ability to respond in a flood event. So we have some resources. I know these slides are going to be out to everybody after the fact and made available online. So just these resources are available if you're interested. But I thank you, and I look forward to the discussion.
Thank you, Mary-Carson. That was a lot of really, really good information. And I hope people are formulating questions as we're going along, and please type them in the chat so we can come back to them at the end of our 3 presentations. And just one quick thing, the letters that people are going to receive, those are not all going out at the same time, right? So they go out on your renewal date or prior to your renewal date. So if you haven't gotten one yet, you still may, correct?
Correct. Yes, absolutely. And in fact, if you haven't gotten one yet, that's normal. You'll get one when you are getting close to your renewal date.
Right. Thank you. But there are things that I know the city of Virginia Beach has been doing for a while to help citizens, not only, to reduce our flooding risks, but it also has the added benefit of helping citizens with our individual insurance rates. So we're going to turn to Whitney McNamara now, who is the floodplain manager and the community rating system manager for the city of Virginia Beach. So welcome, Whitney.
Hi, thank you. Can everyone hear me? Yes, okay, good. I put my headphones in, so sometimes when I do that, it does some weird things. Okay, so let's pull this up. Okay, so just to share with everyone, Virginia Beach does participate in the National Flood Insurance Program. Obviously, we all have the ability to purchase flood insurance. We joined the program in 1971. So we were one of, I want to say, the first 5 communities in the country to join. We were a super, super early joiner. And we currently have almost 22,000 active flood insurance policies in Virginia Beach. And that number might seem low. However, we have to take into account the fact that a lot of our, or at least a portion of our coastal properties have condominiums or multi-residential buildings on them. So the condominium association might carry a policy, but that doesn't mean every single unit in there is going to carry a policy. So that is some of the discrepancy. And I wasn't able to get a up-to-date breakdown of who has preferred risk versus who has a regular, like an AE or a VE flood zone policy, but it's typically around half of them. So the community rating system, as Karen mentioned, it's a program we're participating in because we're doing extra things to help all of our residents prevent flooding, to minimize their risk of flooding, but it also has the added benefit of providing a discount on flood insurance. So that program was created in 1990 to provide discounts on flood insurance. It's a voluntary program. Part of the reason it took us so long to join is we had to actually evaluate it and figure out if it was worth the time and effort that we needed to put into it to join. And there are 18 different activities that we can get points for based on the categories of public information, mapping and regulations, flood damage reduction, and flood warning and response. And as I said, we get points for each of those categories. So we submitted our application to join in October of 2018. We are a Class 7 community, which is a 15% discount on flood insurance policies. And I'll get into some of the details on who gets the discounts and how later. And those discounts began for new policies or policies that renewed on or after May 1st of 2019. And we have, based on that 15% discount, a cumulative savings of over $1 million annually to our residents. And again, that's pre-risk rating 2.0 numbers. I don't have updated numbers, but it's still a substantial savings. So our points come from a wide variety of categories. So we have points for requiring and maintaining elevation certificates. So when a new house is constructed or a house goes through a major improvement, we require an elevation certificate to be submitted to the city as part of that permit. So maintaining those gives us points. Outreach, we get points for. So when you see a message from the city on Facebook saying buy flood insurance, or you see something in your utility bill about flooding and flood insurance, that's how we get those points. Hazard disclosure, this one's a hard one in Virginia as a whole, just based on our laws. There's a lot of points available for places that have robust real estate disclosures, but ours, I'm pretty sure that those 5 come from the fact that it has to be listed on a plat. So if you go and pull a plat for a property, or you need to have a new plat created, you have to actually put the flood zone and delineate the flood zone on that plat. Most of our points, which is really, really cool, comes from preserving open space. So that's a combination of places that the city's preserved as open space, as well as our state parks that are coastal in nature that are preserved open space. So it's a pretty significant portion of our floodplain that is protected from development and maintained for flood storage. And then we get points for higher regulatory standards. So when we require a structure to be elevated above what's on the FEMA maps, we get points for that, and other things like that. Flood data maintenance, so just, you know, maintaining all of the data. Stormwater management is actually an area where we're really interested in reevaluating and providing new information based on the things we've done over the past 5 years to create a more robust stormwater management program. Floodplain management planning, those points are from our hazard mitigation plan. And then the growth adjustment's just a factor they use on some of the different points. And ours is at 1, so it just means that our points are what our points are. So risk rating 2.0 in the CRS program, right now, the two haven't interacted, and it doesn't change how the CRS program works, but that change is probably going to come in the future as FEMA works to align the two programs. One of the biggest changes right now is that previously the 15% discount was only available to policies in a high-risk flood zone, so your AE, your VE flood zones. Now everyone, regardless of their flood zone, receives that discount. However, that discount's delayed until the policy reaches its full risk rate. So MC was talking about how the policies are on a path where if you're paying X number of dollars and they reevaluate under the new rating system and it's a higher amount, but you can only go up that 18% a year. Once you get to that new higher value, that 15% discount will start kicking in again. So takeaway message based on what MC was saying, and based on that is when you get your flood insurance renewal, check it, look at it really closely. If something doesn't look right or you have questions, call your insurance agent and have them walk it through with you. If you don't see the CRS discount on there, call and ask about it, you know, just to make sure something didn't get left off. The worst they're going to say is, yeah, you're not at a full risk rate yet, so we don't have it yet. But keep checking, stay on top of it. I got my renewal right when this all started, and my policy still isn't right. So talk to your insurance agent. They're going to be your biggest help through all of this. And that's all I have for you all tonight. I'm happy to answer questions. I'm always available for a phone call or an email for just floodplain questions on hypothetical of I'm trying to do X, Y, and Z to my house, and I need to know what I need to do to make sure I'm compliant with floodplain. So yeah, anytime there's questions, I'm happy to answer them.
Karen, you're muted.
Sorry about that. Is it correct to say, Whitney, that the discount applies to policyholders all over the city, no matter where they live?
Correct.
The same discount rate.
Yeah.
Rate. Wonderful.
Yeah. And the other thing I would say, if you're in an area that does not require the flood insurance policy as part of your mortgage, and the rate goes up to the point you're looking at your policy and going, this is too expensive for me, again, call your insurance agent, because you may be able to adjust the amounts that you have covered. So instead of covering the entire value of your house, you could maybe drop that down to $100,000 worth of coverage, $50,000 worth of coverage, something that gets you to a rate that you can afford it. Because if you get water in your crawl space, your HVAC system, something that's not in your house and impacting your electrical, it may still cause, $15, $20, $30, $40,000 worth of damage, but it didn't flood your entire house to the point you needed the whole amount. So it's better to have something than to have nothing.
That's very good. Very good advice. Thank you. Thanks, Whitney. And we're going to move to
welcome.
Mike Vernon, who's going to talk to us about all our different options for flood insurance and for things that we can do to mitigate the cost of our individual flood insurance. So welcome, Mike.
Can you hear me now?
Yes, we can.
All right, very good. Hello, everybody. Morgan is going to help me with my slideshow. I've got a setting in my PowerPoint that's not cooperating, so she's going to change the slides for me. What we're going to talk about is basic flood insurance and how it works and what's going on in the marketplace. Some of my presentation overlaps what Whitney and MC talked about, and we'll skip over those and always go back to questions later on. So Morgan, let's go to the next slide. So as people have talked about, we're experiencing some drastic changes that over a long period of time are going to really change a lot about where we live and how we work. We've got changing weather patterns. These storms are getting bigger, stronger. They're covering more territory. We have rising sea levels, long-term erosion. We're constantly replenishing. I live in Chicks Beach, and they've got a major sand replenishment project going on right now. In Hampton Roads, we have a sinking landmass. I mean, the word Pocosin in Indian means great swamp. So the bottom line is we have not only sinking or rising sea levels, but the landmass is sinking as well. And that's going to be an additional problem. And then we have what I refer to here as poor building decisions. And what I use that picture down in the right-hand corner is something that would not be allowed to be built today. Also, for example, basements are not allowed to be built today in these high-risk flood zones. So it may not have been a poor building decision 100 years ago, but in today's world, it has become one. Okay, Morgan. So some of the flood talk. Flood insurance with the National Flood Insurance Program offers about 95% of the residential properties, or covers about 95% of the residential properties required to carry flood insurance, and they're insured by the NFIP. The NFIP is managed by FEMA, which is managed by the Department of Homeland Security. So Mary-Carson touched on the fact that the NFIP is or was supposed to have greater responsibility than just insuring properties. They were supposed to entice flood mitigation in order to lower flood insurance premiums, help with the CRS program that Whitney talked about, and other issues. And 2.0 is not doing that as much as the previous iteration. And we can talk about that in a minute. There's about 75,000 structures in Hampton Roads that are required to carry flood insurance, both residential and commercial. Once you get up into the Northern Neck, Gloucester, Matthews, those areas, the number goes up tremendously. And we also do business in the Outer Banks. And when you get down there, you're really adding a lot of structures required to carry flood insurance. You are required to carry flood insurance if you are in what's considered a high-risk flood zone and you have a federally backed mortgage. Now, there are some mortgage companies out there that will accept private sector, but if you have an FHA or VA loan, you are required to carry a FEMA policy specifically. All right, Morgan. So flood insurance has two basic components, which are coverage for the structure and coverage on contents. Each have their own deductible. Now, coverage on the structure, if you're in a high-risk flood zone with a federally backed mortgage, that's all that's required. Contents is totally voluntary. And what is contents versus what is the structure? So an easy example is if you have a microwave screwed into the wall with your cabinets, that microwave is part of the structure. If you have a microwave sitting on the countertop, that's contents. So if you have carpet that is stapled and glued to the floor versus a throw rug, The carpet on the floor is part of the structure, the throw rug is part of contents. And so, as I said, they both have their own deductible. FEMA on a residential structure offers up to $250,000 of coverage and $100,000 on contents. And so if you have a mortgage that's less than $250,000, you can carry less on the structure. The average premium in our area is almost $900 per year, one of the highest averages in the country. Now, this was based on the old 1.0, so it may have changed with the 2.0. It's been in existence not long enough to do that study at this point in time. But I know for me that since October 1st, there have been a lot of premium reductions due to 2.0, and those are significant. And I'll talk about that in a minute. I often refer to the mortgage companies as the police officers of the flood insurance business. And what I mean by that, it is their job to make sure that they pull a flood zone determination on every property they're going to lend money for and determine if that property is in a high-risk flood zone or not, and to handle it accordingly. So if a mortgage company does not adhere to the policies and they get audited by FEMA, they can actually get fined for not managing their flood portfolio correctly. So they are very strict and very concerned about flood-related issues on every mortgage. As I said, coverage on the structure is required. Contents is voluntary. Contents goes from $0 to $100,000. If you are a renter, you can purchase content coverage only. And sometimes in a business environment, I've had banks, for example, I had a young lady who opened a hair salon, and she borrowed $50,000 from the bank to buy the equipment that she needed for her salon. And as a result of that, she had to buy contents coverage required by the lender to cover the loan and the collateral. Annual premium payments are required, but can be escrowed. So there, to my knowledge, there is not a company on the private sector or on the government sector that accepts any other type of payment except an annual payment. And so if you are required to have flood insurance, then that payment can often be escrowed and paid monthly through your mortgage provider. I have also come across situations where if it's a voluntary policy, the bank will not escrow it. You have to pay it annually in advance of the policy being in effect. And flood insurance can only be canceled during the policy year for certain reasons. There's 8 or 9 reasons. The most common one is if the property is sold, then you provide your insurance provider with the deed of sale, and they can then cancel the policy, and you'd get a prorated refund for the remaining balance of the year. Morgan? So some of the things that are important to the flood industry. We have elevation certificates. Elevation certificates are FEMA documents completed by survey firms, and on that elevation certificate are measurements that are important to pricing flood insurance. As MC touched on, elevation certificates are no longer required at any level. However, we're still studying if they will have, we're still studying what kind of impact they will have on the premiums with 2.0. But the other thing that's important is if you're doing new construction or a major remodel, the city may require you to obtain an elevation certificate in order for them to issue the permits that are necessary for the CRS program. So be prepared to have an elevation certificate for a major construction project. The average claim for flood insurance is about $42,000, the largest of any kind of residential claim in the marketplace. Also, the flood insurance premiums count against what's called DTI. That stands for debt to income ratio. So if you're trying to borrow money for a mortgage, they're going to calculate your debt, your payments, all of your outflow of cash, and flood insurance would count against that debt to income ratio. And if the flood insurance is too high, it could cause the loan to fall through. This is my two 1735K, just another statistic that if you had 2 inches of water in a 1,700 square foot house, the claim would average out to about $35,000. So imagine if you had 4 inches of water, 8 inches of water, how much greater the damage would be. The other thing I wanted to talk about is high-risk flood zones versus low risk. I think both Whitney and MC touched on the fact that everybody in Hampton Road should have flood insurance. And I agree with that. And my little joke is, unless you live on top of Mount Trashmore, maybe you can have an exception. But my attitude, because we have a lot of military, we have a lot of physicians with Terra, people moving into the area, and they have heard about our flood-related issues. And my comeback to them is that I would rather live in a high structure in a high-risk zone than live in a low structure in a low-risk zone. And the reason why is, as MC said, they don't know where the storms don't know where these lines start and stop. In Hurricane Harvey in Houston, 80% of the homes that were destroyed were not in high-risk flood zones. So if I had a line drawn down the middle of the street, and one side of the street was high risk and the other side was low risk, I would look at the structure, and that would help me make the decision on where I wanted to live. And then finally, you've heard both MC and Whitney talk about AE and VE. I break it down a little more simply. Anything starts with an A, anything starts with a V, you're going to be required to have flood insurance if you have a federally backed mortgage. And so X is voluntary. Now, I emailed MC earlier today in a moment of frustration. I have a client that lives in Sandbridge on the ocean, 100 yards from breaking water. We were told that one of the issues that would determine the price of flood insurance with 2.0 was proximity to water. And they were in a VE zone, which is the highest risk. VE is for storm surge, big waves. And this house was built in 1974 before the flood maps were drawn, and it's on a slab, and it's not compliant with today's flood codes. And the premiums are going to go from $10,000 a year that this client has been paying for a number of years to $900 and some change. And I don't understand what happened that reduced that risk. Conversely, I priced a house 2 blocks away from this house on the ocean front that is in an X zone, which is voluntary. Before October 1st of last year, this voluntary policy would have been about $500 a year. Their quote came in at $3,500. So there is a certain amount of frustration in the industry from the lack of predictability, because we know what's in the algorithm, but we don't know how the algorithm is weighted. And so I have a house in a voluntary zone getting charged $3,500, and I've got another client 2 blocks away that is on the ocean front and is getting a 90% reduction in premiums. And that's kind of in a nutshell what's going on with 2.0. Okay, Morgan, thank you. So Morgan was telling me earlier that when we switch from Microsoft to Mac, sometimes there's issues with the font. But basically what FEMA is trying to do is they are adjusting the premiums and in some case raising them. And at the same time, they're using the CRS program to lower exposure. And between those two entities, that's how they hope to regain their balance financially. And I could go on for hours about the National Flood Insurance Program and all of its intricacies. It's definitely the most complicated residential insurance product, and it's something that everybody should consider. One of the things I ask people that are on the fence, and again, I have to be careful now with 2.0, but what I used to say was, with $500,000 or with $500 a year change your life? If you made $500 less next year than you made this year, would it change your life? And they would usually say no. And I said, would losing your house change your life? So it's an easy decision once you look into it and educate yourself about where you are, what's going on with the community, and how flood insurance works. Finally, the other thing is the private sector insurance companies are gradually moving back into the business. It's a little bit of the Wild West out there. They're not very transparent about their financial status or how they rate risk. And so I urge caution. Sometimes there's a very valid reason to go with a private sector company, but there have been private sector companies that have declared bankruptcy in both Florida and Louisiana, leaving people stranded without anyone to pay their claims. Whereas the federal government backs the National Flood Insurance Program. So just be aware that with the private sector, you may get a lower premium, but you also are taking more risk. And when they don't want your business, they just price you out of the market. That same house that I got priced by FEMA at $3,500, a private sector company priced at $12,000, which was their way of saying they didn't want the business. So it's a moving target right now. As Mary-Carson said, they're updating the program every Thursday. So what might have been true last Thursday, it may not be true this Thursday. Anyway, the bottom line is that it's a very fluid marketplace and not very predictable. And the last thing that I want to touch on that Whitney will and Mary-Carson both will understand, in order to score high with the CRS program, the city can't be issuing permits for projects that aren't FEMA compliant. And so builders and major remodels are still having to spend the money to be FEMA compliant in order to be able to pull permits, but they are not getting any financial benefit for it. So the homes are going to cost more in a high-risk flood zone than they would in zones that are not maybe a block away. So one thing to consider as you are maybe planning a major project. So I think that's it. Is this it? Yep. So thank you, Morgan.
Thank you, Mike. That was really helpful. I have a couple of questions, and then I'm going to turn it over to Jim for other questions. And please, if you're viewing with us, put your questions in the chat box, or you can use the Q&A, either one of those. So Mike, you talked about if you have a federally backed mortgage and you're required to have FEMA insurance, that's the only thing that's required is the structure. So can you get contents insurance through your private homeowner's insurance policy?
No, because there's no overlap between homeowners and flood. So you would just simply add contents to the policy that you're buying for the structure. The banks don't care anything about contents. Mm-hmm. And so it's just a matter of evaluating how much your contents are worth, what floor are they on. I mean, for example, if all your valuable contents are on the second or third floor, do you feel compelled to cover them? I often describe risk this way. I could go to sleep at night with all the windows unlocked and the doors open and it wouldn't bother me a bit, but my wife would kill me. So different people have different risk preferences. And I think that's part of the equation. How much risk do you feel? What is the value of your property? And how vulnerable do you feel to flooding? And make the decision accordingly. And the other thing to do is plan for your hurricane season by moving valuables to a safer location, like a lockbox at the bank or other family members, if you feel that you're in danger of losing valuables that, for a gun collection, a jewelry collection, etc.
Thank you. And Whitney, Mike mentioned the sand replenishment project that's going on in his neighborhood right now on the west side of the Lesnar Bridge. Does that affect the community rating system, projects like that?
Yes and no. It's not quite that easy. So the projects that are really going to start affecting us for community rating system are going to be some of the big public works projects that the city's going to be doing. So like some of the tide gates, the pump stations, the stuff. In particular, I've been working with Windsor Woods, Princess Anne Plaza, the lakes, and the public works projects there. And what we'll be doing is it indirectly affects CRS. So those projects are going to change the flood conditions of that neighborhood. So we're applying to FEMA for a letter of map revision. So what that's going to do is once that project comes online, it's going to change the flood maps in that neighborhood. It's also going to reduce flood risk for the residents, obviously. So by changing our maps, that changes how some of the points are weighted. But then there's another categories we can get points for these big public works projects that reduce flood risk. So that's where we're going to really start seeing some of those points. They don't like beach nourishment as much because the sand goes away.
Right.
So
has to be redone periodically.
Yeah, so beach nourishment's really hard to get any kind of points for. An MC can contradict me, but we really don't do anything for that.
One of the things I've taught real estate agents over the years is don't mix flood maps with common sense. Okay, because and my other little joke is if you have anybody that can eyeball base flood, send them my way, I'll hire them tomorrow. I mean, for an example, from about 39th Street on Atlantic Avenue at the oceanfront, all the way to 89th Street on the ocean side, nobody's in a high-risk flood zone. Okay, none of those houses are. I mean, there may be an exception or two that I'm not aware of, but I've been looking at those maps for over 10 years. And now when you get across the street and you get down by the park, and we all know the park is a swamp, then there are houses down there that are in a high-risk flood zone because they get flooded from the back, not from the ocean. So there are areas along the beaches that because of the beach, and Mary-Carson, help me with this one. When they did the Ocean View project and moved the dunes and extended the beach, I know that changed a lot of people's where they were on flood maps, correct?
I am actually not familiar with how those changes impacted their flood maps.
There were people that were in VE zones that got moved to AE zones.
AE, that makes sense.
Which is much less expensive on the old rating system than it was. So some of those projects can have an impact on flood insurance, but the city has to do what Whitney's doing, which is going through the process of applying to FEMA for the reevaluation.
Thank you. And I had one question for Mary-Carson, and then I'm going to turn it over to Jim for questions, for other questions. So Mary-Carson, the condominium example that was given earlier, if you say there are 12 or 20 units in a condominium building, and that insurance is held by the condominium association, is that treated like a business or a residence in terms of the increased caps? Because there's a big difference in how rapidly the insurance rates could increase.
I mean, Mike would know this answer better. I think that they are a primary residence.
Okay.
Yeah, it depends on. Condominiums are very complex when it comes to flood insurance. And it's, for example, if you have a building with more than 5 units, and you have to insure that building individually, is still considered primary residence. So like in downtown Norfolk, there's a building that's 5 or 6 stories tall. It's got X amount of condos in it. And they have a condominium association coverage because that coverage covers the common spaces of the building.
Mm-hmm.
But still, they're paying as a primary policy. And the primary policy also has fewer surcharges than a non-primary. Non-primary has an automatic $250 a year surcharge if it's an investment property, a second home, rental property, business property, etc.
And there is one tiny caveat or an addition to that CAT scenario, and didn't really touch on this, but in addition to investment properties, secondary homes, businesses, that list of the 25% caps, severe repetitive loss properties have to increase at 25%. So that's like that's a consequence of that type of repeat flooding that is most extreme as far as, number of losses and the amount of losses. So those properties are getting a pretty substantial bump up every year. That is consistent with kind of like a best approach from an insurance standpoint, because they are continually flooding. And so you do want them to be paying more for that greater risk. But that is just one more of those additional 25%, not 18%, even if it's your primary residence.
Karen, let me touch on something that none of us spoke about that's really important. Virginia is a buyer beware state, which leaves the due diligence of flood history to the buyer. However, as of January 1st of this year, Andrea McClellan with the City Council of Norfolk was able to get pushed through a document, and the document is a first iteration and it has a few flaws in it. But basically the purpose of the document is if a homeowner knows that they've had 2 flood claims or more within a rolling 10-year time frame, then the seller has to provide that information to the buyer. Now, FEMA's position on all of this is that they will not provide flood history to anybody but the owner of the house. So that's the oxymoron, is that if you are a buyer and you're having to practice buyer beware, but you can't get hold of the information, then that's an issue. And there have been people who have bought houses that had an extensive flood history and never knew it until their first flood. So,
and what you mentioned, the Councilwoman McClellan is doing, that only applies in Norfolk, though?
No, that's for the entire state.
Oh, it's for the whole state. Okay. Jim, I'm going to turn it over to you.
MC,
I think you have some questions. MC,
do you have something on that?
Nope, I was just going to say that's correct. And actual knowledge, that's
well, it's actual knowledge. So, for example, if 2 homeowners prior had 2 floods in a rolling 10-year time frame, then and the current owner doesn't know that,
right?
Then, and the other thing that's a flaw in it, it says we've had 2 flood claims from the National Flood Insurance Program. What if you had 1 claim from the FEMA and 1 claim from Neptune? Well, you don't have to sign the document. So, like I said, it's first iteration, and Andrea did a great job getting it pushed through. I have no criticisms on it. It just has to be cleaned up. I mean, for example, rolling 10-year time frame is an actual financial legal term. And if you don't know what rolling 10-year time frame means, you wouldn't know how to interpret when the floods occurred in its history. So it's a great start, and I commend it 100%, but it just needs to be cleaned up as we go forward.
Yep.
Jim, did you have some questions?
Yeah, I had a couple. The audience that's live today has asked a couple. Mary-Carson, you answered Chris O's question about living on a man-made lake. That happens, that's all over Virginia Beach for man-made lakes. So if you could kind of talk about that for a minute for the rest of the audience.
Yes, the question is the man-made lake part of that rating variable that is, your distance from a flooding source or a water body, coast, whatever. Man-made lakes are a water body, obviously, and so that's going to be a factor, but we just don't know how aggressively the rating factor looks at, you know, man-made lakes and their flood risk versus, you know, a river or coast. I mean, one should assume that if you are closer to a bay that's tidally influenced, that you will not, you will not be treated the same way as this this neighbor's house. That's what the hope is, and we just don't know. I have no way to verify that answer, unfortunately.
Yeah. Okay, perfect. Thank you. And Amanda has a question for anybody who can answer it. What type of foundation is most vulnerable to flooding?
Do you want me to answer that?
Yeah, go ahead.
Yeah.
The ones that I'm most concerned about are the slabs that were built in the 60s and the 70s, early 70s. And the reason why, the maps in Hampton Roads, for the most part, weren't drawn until sometime in the mid 70s, correct, Whitney? And so anything built before that, like Glen Haven Colony, they did not have a frame of reference on how high to build it to be safe. They didn't have what was called base flood elevation information. And so they built it pretty much whatever height they wanted. And so if you go to some areas like Windsor Oaks and Windsor Woods that suffered a lot of damage during Matthew, a lot of those homes are right at base flood, maybe a little bit higher, maybe a little bit lower. But because they were on a slab, they didn't have the benefit of a crawl space, you know, taking them up another 2 or 3 feet. So slabs at base flood or under scare the heck out of me, and I would never let my kids buy one. I can't go out in the community and constantly say that, but that's the one that scares me. The next one that scares me is basements. I mean, the basements, when water starts filling up in an enclosed area like a garage or a basement, crawl spaces, it builds up hydrostatic pressure, which can cause foundational damage. Plus, a lot of people have moved a lot of mechanical and electrical down in the basements, and that's a big price tag for us taxpayers to pay right off the bat. And so I think basements, slabs are in it. But the main thing is, what is the relation of the first enclosed living floor that you walk into the house on? What is the relationship with the base flood elevation? Mm-hmm. And, you know, with new code in Virginia Beach is 2 feet above base flood, right, Whitney? And then most other
Yes.
cities is 3 feet above base flood. And so whenever you're around base flood, almost anytime I see a house with a flood history, it's usually even with base flood or lower.
Great. Thank you for answering that question, and also for answering the other couple other questions that I had written down, specifically about severe repetitive loss properties and buyer beware. You did a great job, hit a homer on both of those answers. Thank you for that. This one is for, I think, Mary-Carson, and it's with the new flood insurance program rating methodology, keep pace with the changes in storm frequency and intensity and the resulting flooding vulnerability that climate change causes.
So it is supposed to take into account storms, historic and projected. It is not required to take climate change into consideration. The intention is that it will in the future. That's kind of the response that we're getting from FEMA. But it is important to reiterate that this update and this new rating method is supposed to function like traditional insurance rating methods and approaches. So it is supposed to be changing, not necessarily annually, but more frequently over time. The congressional caps will still be in place until that law is changed. But when we've talked with FEMA about the moving target of the full risk rate, the response has been, we're trying to function like a real insurance company, and we expect that just like a real insurance company, our rates will be variable annually. So
Well,
I think,
I'm sorry, I'm saying, go ahead.
no, I just think that that's what we should expect from this program. It's just, the problem is that the program is so entrenched in the way that we build, the way that we zone, the way that we, you know, make so many choices. It's just an entrenched insurance instrument in our regulation world. And that's what's making this transition a challenge. Sorry, go ahead, Mike.
I can just tell you that since October 1st, I'm experiencing with my clients incredible and tremendous premium reductions. I had an apartment complex that I insure. The premiums last year were $23,000. I renewed them today for $9,000. All of my clients in VE zones, the storm surge, the ones on the ocean fronts, all of them are going down by 90%. I mean, I had one go from 10,000 to 1. I had one go from 8,000, almost 9,000 to 1,100. I had a lady on the Chesapeake Bay go from 6,000 to 400. I'm not seeing in Hampton roads well, first of all, you're not going to get a major increase because you can only go up 18% as your primary residence. But I am hearing stories about in Florida, Alabama, Louisiana, South Texas that are experiencing significant increases, but I have not experienced that here.
That's a good lead in for the final question that I have, and then we can wrap it up. And that's kind of touched on by all of you, and that's the close to the coast map. But the question was, Virginia Beach has 9 different watersheds, and how does the watershed one lives in affect their flood insurance calculations?
That's what we don't know. That's what, Mary, do you have an answer to that? Because I've got people, like I said, living on the water that are getting tremendous premium decreases. I have one client that lives in Colonial Heights, severe repetitive loss. When I met them, they were paying $11,000 a year. I was able to make some administrative changes, get it down to 6. They just got the renewal notice as an SRL, and they went to 900, and they've had 5 flood claims. So
yeah, I think the flood insurance,
and they live on the water.
Yeah, I think the flood insurance is less clear, but I think that interestingly in Virginia Beach, the city is taking a really alternative approach to zoning and, you know, their own regulation of these watersheds. And so, you know, Whitney, I'm sure, could speak to, you know, just the differences in terms of what's required from the city's standpoint based off of that changing risk.
Mm-hmm.
Yeah, so I mean, it's not so much how it impacts flood insurance, but with our stormwater models and the master drainage study, we've been able to model, you know, basically any design storm you want, using the accurate precipitation levels that we know our region's experiencing and add sea level rise to it. So now how we're regulating new development, and that's always the hard part, is the regulations apply to new, but they don't help all the things that have come before. But for new development, you have to either be 2 feet above our modeled base flood elevation or the FEMA base flood elevation, whichever is higher. So while we're recognizing that we need to use the maps as a regulatory tool to offer flood insurance, we also recognize that we have better data and have a better awareness of how Virginia Beach experiences flooding that isn't shown on a FEMA map.
Well, and add on to the conversation, with the fact that it's all brand new and just now April 1st is fully in effect, and 2, that they're changing it literally every Thursday, and 3, they believe they've made some mistakes that they're trying to correct. It may be a number of years before we know what is the actual impact of somebody purchasing an elevation certificate? What is the actual impact of living on a lake versus the ocean? What is the actual impact of having of $2 million? For Mary-Carson brought up somebody having a $250,000 house and a $2 million house. I actually disagree with her position, and her and I debate this stuff all the time, so it's not like we agree all the time. But I mean, my point is, you're only going to pay out $250,000. Why should you be paying more just because you have more house that isn't going to receive a benefit? So, you know, but there is part of this, since it is a government program, it has to have financial equality, and so people can argue that standpoint. But the bottom line is, it's a moving target right now. It's all new. Us being out in the field, since we don't know how the algorithm is weighted, we can't give quantifiable feedback to the program because we don't know how it got priced that way to begin with.
Mm-hmm.
So it may be a while before we could have another panel like this, and people a lot smarter than me can sit there and figure out, you know, what it all means, and what, you know, 6 months ago, if a builder called me and said, I'm going to build a house and I'm going to do this, and I'm going to build it this high, and I'm going to put in flood vents, I could say, premium is going to be $550. And now I quoted one the other day, brand new, 100% compliant, premiums came in at $1,800. And I don't know why.
Well, it's a work in progress, and
Yes.
I appreciate that, the honesty and transparency that you have all answered these questions with, because they're not easy and it's a changing world. So thanks a million for joining tonight, and I'm going to turn it over to Karen to wrap it up. Karen?
Well, I just want to add my thanks to Mary-Carson and Whitney and Mike. We all know a whole lot more than we did an hour and a half ago. We may not have all the answers, any of us yet, and it is an evolving program, but we know a lot more. And I guess the most important thing for anyone viewing to take away is to ask questions. So when your letter, your renewal letter comes, look at it carefully and ask questions. If you're, you know, don't understand why you're paying what you are for flood insurance, ask questions. If you're not even sure if you have flood insurance, ask questions. So, you know, find out the answers to those to the best that you can. And I thank you all for joining us this evening. I think it's been really helpful and educational, and maybe we'll follow up a year from now when we have a little more experience with this new system. So thank you and good night.
Thank you.